In mid-June 2026, Bitcoin's spot price broke away from its $120,000 peak, tumbling downward to stabilize in the $60,000 to $70,000 range. To understand a $50,000 drawdown, we first have to examine the mechanical engine that accelerated it, the perpetual futures market. In derivatives trading, leverage requires maintenance. Traders pay a premium, known as funding rates, to keep their leveraged positions open over time. This chart shows Bitcoin funding rates. The black spot price line and green bars show bullish leveraged long positions building up. By mid-June, that leverage fractured. Forced liquidations drove the price downward, flipping green bars into deep negative red spikes as traders paid to exit. Identifying a leverage wipeout only gives us the trigger. It doesn't tell us if the underlying macroeconomic structure of the network is actually broken. Derivatives data is inherently noisy and built entirely on speculation. For a definitive answer on market structure, we have to look directly at the immutable settlement data on the Bitcoin blockchain. The network tracks value using unspent transaction outputs, or UTXOs. A UTXO acts as a permanent receipt, recording the exact moment a specific coin last moved. This provides a mathematically precise cost basis for every single participant. By aggregating these UTXOs, onchain analysis segments the entire network into specific behavioral cohorts based on exactly how long they have held their assets. Separating recent buyers from veteran holders isolates the data. It allows us to distinguish the localized panic of a new entrant from the broad macroeconomic conviction of long-term capital. By auditing the aggregate profitability and the specific reactions of these distinct cohorts, we can accurately categorize the June 2026 crash as either a structural bear market or a healthy mid-cycle reset. This chart shows the MVRV Z-score. It measures the deviation between Bitcoin's theoretical market cap and its realized value, using the orange Z-score line to gauge aggregate network profitability. Historically, when that orange line breaches the upper red band, the aggregate market is in a state of euphoria, marking a cycle top. When it hits the lower green band, the market has reached a cycle bottom. Looking at the 2026 drawdown, the aggregate score exits the red band and descends toward the neutral midline. It stops short of the green capitulation zone. This mean reversion clears out the speculative froth, resetting the metric to a neutral stance without breaking the overarching uptrend. We can cross-verify this sentiment shift with a chart of net unrealized profit and loss, or NUPL, which tracks profitability through colored horizontal bands ranging from capitulation up to euphoria and greed. In recent months, a blue NUPL line plummets out of the pink euphoria zone and stabilizes inside the yellow optimism and anxiety zone. Despite a $50,000 drop in spot price, the metric remains above zero. The average network participant is still holding a profitable position. These aggregate oscillators map out a mid-cycle leverage flush. The market removed late-stage exuberance, but avoided a transition into a prolonged bear market. If the macro averages remain stable, the extreme volatility we saw must be localized. The pain is concentrated within the most recent market entrants. On-chain, we define the short-term holder cohort as any entity controlling coins that have been dormant for less than 155 days. This chart displays the short-term holder realized price. The orange line acts as the aggregate cost basis, or the average break-even point for this entire speculative class.
The black spot price drops through the orange line, instantly plunging the entire cohort into negative territory. Suddenly holding unrealized losses, this reactive group is forced into severe psychological and mechanical pressure. This localized spot capitulation maps onto the derivatives wipeout. Underwater spot positions trigger automated stop losses. Those sales drive the price lower, forcing leverage longs into liquidation and generating the sharp negative funding cascades on screen. This sequence of data signatures defines a contained capitulation. It is a rapid but contained purge of weak hands and over-leveraged latecomers. The acute panic breaking the short-term speculators creates downward pressure, but the network avoids a systemic collapse because of the behavior of its veteran participants. This chart illustrates the long-term holder realized price, defining the baseline cost basis for capital that has remained dormant for over 155 days. Notice the vertical gap separating the 2026 spot price from the orange long-term holder line, which lingers in the $30,000 to $40,000 range. This profit cushion insulates the cohort from current market volatility.
Long-term entities do not feel the underwater pressure currently breaking the short-term buyers. We can verify their behavior by looking at this chart of long-term holder supply, where the blue shaded region tracks the total volume of coins they hold. As the spot price falls through June 2026, the blue shaded area does not contract. It stabilizes and continues rising towards 16 million Bitcoin. They are accumulating. By absorbing the volatility and refusing to sell into the short-term panic, these long-term holders provide the structural bedrock that blocks a macro collapse. Placing these two opposing behaviors side by side reveals the internal composition of June 2026 market. On-chain, this environment is a wealth transfer, coins moving from weak, leveraged hands into cold storage. Relying strictly on spot price action or derivative liquidations would flag a $50,000 drop as the start of a devastating bear market. But mapping out the exact UTXO cost basis of the network allows us to filter out the noise of derivatives-driven panic. The on-chain profile confirms exactly what happened. The market executed a necessary mid-cycle reset, purging speculative excess while leaving the foundational macroeconomic structure intact.